Everyone, thanks for joining us this evening. We're just going to give it a few more minutes before we get started, just in case we have a few more stragglers. Topic for the night, retirement planning, an evidence-based approach to retirement planning. As a quick introduction, I'm the co-founder of Endowus. Thank you so much again for joining us tonight. And we'll get started in just a few minutes. And while we are waiting to get started, just a few more things to highlight. We'll be having another webinar next Wednesday at 7 p.m. I'm very fortunate to be hosting Dinesh, co-founder of Dollars and Cents, which I'm sure all of you know, to talk about investing in Singaporean companies and home buyers, and whether that is the right or wrong strategy. And the following week, Sheng-Shi, our personal finance lead, will be talking to Firepath Lion, talking about the practical approach to financial freedom. So two very exciting talks, which I hope all of you can join us for. And as always, we always need to put a disclaimer up front. And this is more of an educational session than anything else. So please do not take what we say here as gospel. We're going to give it just another minute or two, but this is the mission statement that we like to put up to remind ourselves what we're doing. We help people invest better so they can live easier today and live better tomorrow, to and through retirement, basically. And just as a reminder for those of you who's joining us for the first time, there is a chat function where you can actually send me your questions throughout the talk, and I'll try my best to address them at the right intervals, or if it's a particular question about a particular slide at any given point, I'll try to cut in. But if you have any questions about what we're talking about, please feel free to drop me a line in the chat. I'll try my best to sort of manage that while I'm also talking to all of you. So thanks again. All right, so I think we've given everyone, or the stragglers, a three-minute window to catch up. And I think, to be fair to all of those of you who are on time, let's get started. So Endowus, a quick introduction to who we are. Myself, my name is Yuning. I'm one of the co-founders of the company. I've spent most of my life working in and around finance. My first job out of school was doing investment banking at Goldman Sachs, followed by private equity at Blackstone. I went and did my MBA at Harvard Business School, followed by some time in a hedge fund in the US, before coming back to Singapore about 7 years ago, where I led a large family office based out of Singapore. Our team, we're very fortunate to have a highly experienced team. I'd like to highlight Sam in particular, my partner and our CIO. He spent more than 25 years in the industry, and prior to joining Endowus, he's the CEO and CIO of Morgan Stanley Investment Management in Asia, where I think they run somewhere upwards of $50 billion out of this office here. So we started Endowus because we were struggling to sort of find a way to manage our own money. Most of us in the company are professionals, and we've been in and around the financial world for a long time. And we've always found it difficult in Singapore, with very high costs, with misaligned advice, lack of access to good products. It's really strange, Singapore, for such a rich country that it is, just had very few options that someone like myself would be keen to use when I was looking to manage my own investments. And so we tried to fix that. I mean, that was a pain point that we all kind of figured out on our own, and we came together to try to fix that. And again, you know, what we're trying to do is help our customers, help people invest better so that we can have better lives, live better today, live better tomorrow, to and through retirement. We're very happy to say that we're first and only digital advisor for CPF, SRS and Cash, which for most Singaporeans will be sort of all your pools of wealth, so that you can also sort of one-stop shop look at investing your cash and savings in one place, which hasn't been true previously. So there are a few things that we really care about at Endowus: access, advice, and cost. Access, we build up portfolios in institutional share classes. Basically what this means is that you get the best product at the lowest cost. We believe in working with the largest fund managers out there rather than reinventing the wheel. We work with the likes of PIMCO, with Vanguard, with Dimensional, some of the leaders in the industry. Why try to reinvent everything that they've done when frankly they can do it very, very well? They're very, very good at what they do, and we can work with them and just frankly get our customers the best access there is. Advice, we help our customers think about asset allocation. We help educate, bring evidence and science together to put together the best portfolios they possibly can, and pull that together into one portfolio where CPF, SRS, and Cash are all managed. And that's importantly cost. So one thing I highlighted previously was cost. Cost has always been quite high in Singapore, unfortunately, when it invests, and cost has a direct impact on your bottom line. I'll show you a little bit more information about it later, but we believed in full transparency. We took away sales charges, we took away transaction fees. We even took the step of rebating trailer fees, which is something that very few people know about, but generally in that total expense ratio you pay to the fund manager, a certain part of it gets rebated back to or given back to the distribution, the broker, the financial advisor as an incentive. We actually give that all back to our clients. And we try to design it in a way that's most tax and currency efficient for Singapore-based investors. So, this is what our platform looks like. If you get a chance while I'm talking, please feel free to check us out. And we'll have a few links at the end to get you started as well. This is sort of a quick way to think about sort of what we have on offer. If you think about your money in buckets in terms of sort of liquidity need, there's stuff that you need. You don't know if you need today, tomorrow, in the next week or so. That's something that you need to have a cash management tool, where you probably can't take too much risk. You can't afford to lose maybe more than 1 or 2% in your investment, but you still want a better yield than what the bank gives you. That's our Cash Smart product, which has been very popular since we launched it. So please feel free to check that out. And as you look out, as you go to a 2, 5, 10, 20-year horizon, then you can start to think about investing in the financial markets and stocks and bonds. And that balance really depends on how much time you have to see yourself through the volatility of the markets, because markets are volatile. You can lose money, and most likely you will lose money at some point. And it's a question of, do you have the ability to sit through the ups and the downs of the financial market? So, we have the ability to serve every single pocket and every single need that you have. So we put our clients in globally diversified portfolios, working with, like I mentioned, the likes of PIMCO, Dimensional, Wellington, UOB, First State, Vanguard, Schroders, Lion Global, Aberdeen. And we work with UOB Kay Hian, who's your custodian. All accounts are in your own name. I'll show you a little flow later about how safe your assets are with us. And most importantly, Singapore's a small place. You work here, you live here, your assets are here, your property is here. You work most likely for a Singaporean company. Your CPF is managed by the Singaporean government. It makes sense to diversify a little bit, to put your money globally and ride on the growth of the entire world. So we help our customers spread their wealth globally and invest globally. A little bit about our value proposition. Again, we access the best-in-class institutional funds at the lowest cost. All of these are globally diversified. We offer Sing dollar and Sing dollar hedged share classes, which means that you don't really have to worry about expensive currency transaction fees. We rebate all the access trader fees to our customers. There's no lockup, there's daily liquidity, no sales charges up front. You put your money in today, and if tomorrow your need changes dramatically, you need to pull it out. There's nothing stopping you from doing that, no fees, etc. So, and most importantly, the money is held in your name by UOB Kay Hian, so that you know that if we disappear, or if even UOB Kay Hian disappears tomorrow, which is, by the way, the largest brokerage in Singapore, your assets are still safe. And most importantly, again, we are the first and only digital advisor that can serve CPF, SRS, and Cash, so serving every pool of your wealth. So tonight's talk is about retirement planning, investing, and how to think about retirement planning in a systematic and quantitative way. So 3 key questions that I would love to address tonight. The first is how much do I need for retirement? Secondly, why would you invest your CPF? Again, we serve 3 buckets of wealth, but using CPF as an example, why would you invest your CPF? We're very proud of the fact that we have a solution for that. It may not be the best idea for everyone, but we have a very compelling case for that. And we believe, personally, I believe I put most of my CPF into our solution. And lastly, sort of what is the right way to invest towards your goals, towards your retirement goals? So starting off with how much money you need for retirement, whether you have enough. I think that really depends, and it really depends on a few factors. So first thing you need to do is understand the 3 steps to an evidence-based retirement investing. The first is to think about a reasonable rate of decumulation. You think about your savings and your investments as a pool of wealth. So every dollar you save is an asset that can generate returns for you in the future, or now and into the future. And that pool of wealth slowly accumulates over time. Your salary, the salary minus your spending goes into that pool. Your pool of wealth grows over time. Hopefully you invest it and it grows bigger and bigger and bigger. And at some point when you're retired or you stop having income, you need to start drawing down on that. And it could start to shrink, or if you do it well, it could stay constant. You have to take into account of inflation. Inflation is very, very real. Prices go up. As importantly as understanding how much you need, which is your rate of decumulation, how much you need for monthly, annual expenses, you also need to think about what kind of person you are. Very important in investing is understanding your emotional state. If you're the type of person that can deal with a bit of volatility, you are not compelled to log into your investment account every day to check the investment value. And the first moment the portfolio drops 2%, you sell everything because you're scared, right? And 5% and you're completely stressed out and can't function, right? Then maybe you can take a bit more volatility. For those folks that can't or don't have the ability to because of personal reasons, right? Then you have to choose a less volatile, maybe more fixed income heavy type portfolio. And most importantly as well, you have to understand your risk of running out of money. Today, I believe the average age in Singapore, the lifespan in Singapore is about 84 to 85 years. So from retirement at 62, 65, we still have at least 20 plus years before that we need our money to last. So there is a real risk that we run out of money. So that's something that we're going to be digging into today a bit more. Inflation, first of all. So life gets expensive. This is Coke, used to be 5 cents a bottle. I think if you go to a vending machine today, it's $1. And if you look at Singapore-based statistics, you'll see that in the last 40 or 50 years, prices have gone 4 to 5 times. So inflation is real, no matter where you are, where you live. A plate of chicken rice was probably 50 cents a dollar many years ago, and now it's $3, $4, $5 depending where you go. So inflation is real. So the amount of money you have cannot stay constant. If you have $100 today, and that's enough for retirement today, that will not be enough for retirement 10, 20 years from now. So the key is to grow that pool of wealth. So to help better understand exactly what that means, my partner and co-founder Greg came up with this concept of chicken and the eggs. A very interesting way to think about wealth, retirement, investing, and all sorts of other fun stuff. So there are 2 sources of income that you have through your life. And we like to describe it as work chicken and wealth chicken. So chickens are your wealth, right? They can give you eggs if you treat them well enough. And so how do we think about this work chicken versus wealth chicken concept? The work chicken, it's you. So as you work, every year you earn a certain amount of money. Let's say you earn $50,000, $60,000 a year. You have to spend a certain part of that, right? But net of that, hopefully, you do have some savings. So that is, so that amount of income that you have should hopefully grow over your lifespan, right? But slows down and actually drops off to 0 as you reach retirement. And so that's your work chicken. So every year you earn a certain amount of income, and you set it aside. And that money you set aside then becomes your wealth chicken, right? Money you save, money you inherit if you're lucky enough, or invest, right? That's your financial capital. And that, depending on how you take care of it, if you leave it in the bank at 0.05% interest rates, then it really won't do very much for you. It'll stay constant. But if you are careful about how you manage it, at some point it can become a very large contributor to your income. So you have your work income, and at some point your financial investment and wealth income can actually exceed that. So if you look at the chart on the right, this is someone who at the age of 25 starts working, is fortunate enough to get an income of $60,000 a year. For the purposes of this example, we're assuming that this person's income grows at 3% per year until the retirement age of 65. And every year out of that 60,000, they spend 30,000. we're assuming that inflation grows a bit slower than your wage growth. So inflation at 2%. So in the first year, you're spending 30,000. The next year, you're spending 30,600. So net in the first year, this person in this example is setting aside 30,000 of savings, and that all goes into an investment pool that is generating an annual return of 5% per annum, which is a relatively fair assumption for a medium risk portfolio. What's really interesting is if you see that 5% per annum in the first year, you've set aside 30,000, your 5% is only really giving you $150. It's not very much. But as you build and as you build and as you build, that 5% becomes larger and larger and larger. And somewhere in your 50s, right, even though your work income and salary have been growing at 3% per year from a really high base, your returns from your investment portfolio will exceed how much you can make from your work income. And if you look at that red line, at some point, it's multiples of what you ever made while working. So this person in this example, at some point, I think stops earning about 200,000 a year. But in their 70s, they start crossing $500,000 a year in income. So this is a really interesting example to help think about what wealth income looks like versus work income, and the importance of investing your money well so they can generate both streams of income. And for investments, when you start thinking about investment portfolio, that wealth bucket, the wealth chicken we talked about, you have a few choices. You can do the proverbial eat the chicken and store the eggs, and you don't really do anything with it. You leave it in the bank, you leave it under your mattress. Today, unfortunately, bank deposits earn you absolutely nothing. You could take a little bit of risk, right? Feed the chicken a little bit without taking very much risk. You can leave it in your CPF ordinary account, earning an interest of 2.5%, which is great because the Singapore government guarantees it, and I have full faith in the Singapore government to stand by the obligations. But to me, 2.5% doesn't really cut it. You can move it to your retirement account, your special account, earn you 4%, but there's a lot of restrictions around that. What you could consider doing is potentially taking a bit more risk, which is moving your money into a balanced portfolio of stocks and bonds, and taking the returns that come. And the hope is that if you do that, you'll be able to see returns which will allow you to grow that wealth bucket and enjoy a much higher quality retirement. So when we talked about withdrawal rates, so the concept of this is, in retirement, how much money do you need on an annual basis to fund your expenses, right? Everything from food to housing, to holidays if you want, if you have a car, if you still need to pay rent at that point. And what's really important is your withdrawal rate as well as your returns. And how do we understand it from this chart? And I'll show you why how withdrawal rate, what kind of impact withdrawal rate has on how much money and what kind of investments you need to make, as well as what type of portfolio you pick. So this example assumes a 5% withdrawal rate with 1 million starting value. What that means is the first year you have $1 million in your investment portfolio, and you take out 50,000 because that's your expenses, right? We assume, using a Monte Carlo simulation, we run simulations on historical returns in stock and bond portfolios, right? And also assume that every year your 5% of your 50,000 increases by 2% a year because of inflation. Every year you need a bit more money to enjoy the same quality of living. First year is 50,000, second year is 51,000, and so on and so forth. So what this is meant to show is that if you were to, from right to left, to have absolutely no investment at all and just leave your money under your mattress, earning nothing, right? The chance of your money lasting 30 years, which, in today's environment, if you retire at, let's say, 62 or 65, the expected life expectancy in Singapore is already 85 by the time, we get up there. I'm guessing you'll be closer to 90, right? So 30 years is a fair assumption because some will undershoot, some will overshoot. And the real risk is that you run out of money in the later years of your life, and what that does to your quality of living when you really need to start worrying about medical bills and things like that. So furthest right is no investment. And this person has a 0 chance of the money lasting 30 years. Why? Very simple. If you take 50,000 a year starting first year, inflating that. And every year you draw out that 50,000 out of that million, it's not going to last you 30 years. You have a 0% chance of lasting that long. And actually, in reality, it lasts you about 17 years. If you put it in as 2.5% return, which is similar to sort of what your CPF OA will get you, the average using Monte Carlo simulation, it will last you about 21 years. And the chance of that lasting, that amount of money lasting 30 years is 0. Even at 4%, because your withdrawal rate is at 5%, the chance of the money lasting 30 years is 0. And on average will last about 25 years. What's really interesting that if you start to take a bit more risk, the chance of that money, of your $1 million lasting you till retirement is actually higher and higher. It goes beyond 60, 66, 69% at some point. And also at retirement, the median ending value for people who have invested in a stock and bond portfolio is 1.1 million and 400,000 respectively. So what that means is that you have enough money to last you through 30 years from retirement, plus you have something to leave your family, your children, your spouse. And I believe that's what most of us would like to do. So this is exactly the same example with a 4% withdrawal, right? And you see that the numbers change a little bit. What has happened is that the 4% per annum suddenly looks okay because you're drawing out 4% and you're getting a 4% return. So the chance of lasting 30 years, definitely, it matches the cash flow in and out match, and you'll definitely survive 30 years. But what's interesting is with 100% stock in the 60-40 stock bond portfolio, right? You actually end up with a much larger, in the median case, much larger exit value. So the person in the middle of performance ends up with 1.45 million on the 60-40 bond portfolio at the end of their life with a 93% chance of having that money last 30 years. And on average, it lasts close to 29.7 years, I guess. And obviously, if you drop the withdrawal rate, which means that you go from 50,000 a year to withdrawing 30,000 a year, then the numbers look a lot better for every single case. But what's really interesting to highlight is that if you keep your money invested, the chance of your money lasting 30 years is not insignificantly different. It's not significantly different from just leaving it in a 4% retirement account or special account. But what you end up with the end of your life, in case you, let's say you live to 95, 100, 105, 110, or in case you have a big family that you want to leave something to, right? That average value becomes a lot higher, and you end up with a lot more at the end of your time. This is the median outcome. So median is sort of the middle outcome, the guy right in the middle, right? Based on all the simulations we did. And this sort of shows you how that wealth changes over time from year one, right? Where every portfolio starts off with $1 million, right? Top is obviously the 100% stock portfolio, right? The median person ends off with 2.27 million, right? And on the no investment side, your money goes to 0 at 20 years. So you have 0 chance of having that money last you to 30 years. So this is kind of how the outcomes look. And this is why we are strong believers and proponents of the fact that even at retirement or even close to retirement, even in retirement, you have to think about how to invest your money to have it last through your retirement. For those of you who like to see data, this is a very messy way of demonstrating our Monte Carlo results. What is very, very important to highlight. So, sorry, the blue and the green are the blue is 100% stock portfolio from this page, 60-40 stock bond portfolio with all the different Monte Carlo simulation results. What is very important to highlight is that investing is not risk-free, right? And there are chances that investing in markets, if you are really, 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 really unlucky, could end up put you in a worse position. But most outcomes with a relatively safe margin definitely put you above in that space, which is a much more desirable outcome at a 4% withdrawal rate. So, we at Endowus, we believe that money is meant to enable your life, not to control your life. And we really want to help you do that. So there is a question about what you will do with your chicken, your wealth chicken versus your work/income chicken. And once you've figured out, and how you do this is you start to keep track of your daily expenses, right? How much you transport, be it you take a bus, you take a taxi, you take a Grab, you own a car, and you go to the market, you eat out. What are your expenses? Figure that out, right? I mean, how much do you need on a monthly and annual basis, right? And once you figured out that number, if you divide it by the withdrawal rate, that will give you a very good idea of sort of how much you need when you start withdrawals at the point of retirement, when you have no more work income coming in, basically. As a rule of thumb, we like to use 4%. There's no right answer. It really depends. But 4% seems, based on our previous, based on Greg's work, to be a relatively safe number. So how much do you need for retirement? To answer that question, it's a lot about your withdrawal rate, how much you need on a monthly basis, and also your risk tolerance. And talking a bit more about financial planning, retirement planning, in terms of investing, that's the next step of this. So a question we get a lot when we talk to people about investing their CPF is that CPF pays 2.5% guaranteed by the government. And that's absolutely true. Again, I think this is a fantastic program. CPF is a great program. I can guarantee you that most Singaporeans would not be saving as much if it wasn't for CPF. But 2.5%, frankly, you can do better in most situations. But let's talk a bit more about CPF. What is CPF's OA is 2.5%? As stated by the CPF board, the OA monies earn a minimum of 2.5% or the 3-month average of the major local bank's interest rate, whichever is higher. So, and the government has the ability to legislate the minimum. So if you look at the chart on the right, this basically shows you CPF OA interest rate versus the Singapore savings deposit rate. And you'll see that CPF returns have always been higher than the bank deposit rates. However, over time, especially since the early 2000s, they've started to diverge a lot, where the floor at 2.5% is substantially higher than what the banks give you, which means great. The government's treating us very well and doing us a favor by giving us this, because the alternative is if we were actually able to save as much as CPF forces us to save, we put in the bank, right? But if you really think about it, your CPF money is very, very long-term money. When Singaporeans, start 21, 22, 23, start working till the point of retirement, 62, 65, when you pull out your money, that's 30, 40 years, right? 40 years at least. So that time, that duration, means that you have the ability to stomach a lot more risk with your money. Because if you remember, in the previous example, you make 60,000 a year, you're only spending 30, right? So net, you have savings. So you actually don't need to depend on your investment bucket until you retire, because you always have a net saving. Your income hopefully always exceeds your expenses, and if it doesn't, you should really relook at your finances, right? But because your money is locked up in CPF for 30 to 40 years, right? If you take it and put it into the financial markets, if you look at the markets in this chart, for example, what the MSCI or Country World Index does, there are some years it does terribly. In 2008, it was down 40+%, right? And some years it does great. Some years it's down close to 40%. But on average, that return actually far outstrips. A lot more volatility up and down, and that's why it's very important that you have a very, very strong stomach to be able to sit through this. But that's why, on the average, it actually works out in a very, very interesting way. So again, remember, because we're dealing with 20, 30, 40-year time horizons, we like, when we show our numbers, we like to show numbers of that duration as well. And again, that's why we always say that you have to have the emotional fortitude to put your money in, close your eyes and walk away, and obviously keep putting money in as you go along, keep investing, but you have to be able to deal with ups and the downs. And this is the perfect example of it. So 30 years of data from 1990 until June 2020, right? For $1 put in into an MSCI or Country World Index versus your CPF OA. The CPF OA line is straight, 2.5% a year. No matter what happens in the world, the government takes care of you, right? So there's zero volatility in that. So you know that every year your money's worth a little bit more. MSCI or Country World, you could lose money. And in this specific example, where if you started off in the 90s, you were actually underwater for most of the 90s. If you look at that red line, right, you were actually below what a CPF portfolio would have done for you for many years, right? But at some point you went over. And as we got closer to the dot-com bubble and the tail end of that, obviously, it started to far exceed the CPF bubble, and when everything collapsed, you actually went below, right? Which is shocking, right? After so many years, can you imagine still being below the CPF 2.5%? But wait, if you look a bit further, markets recover, it goes up. Again, 2008, 2009, you go below. But as you follow, look what happens, right? As your duration gets pulled longer and longer and longer, right? Every dollar you put in from year one, or every 100,000 in this example, ends up at 235,000 roughly, which is a great return, right? I mean, zero risk, 2.5% a year, every single year. But if you had kept your money invested in the MSCI World, you'd end up with 4 times your money at 500,000, right? And this is why, sorry, 5 times your money at 500,000. So this is why it's very, very important to think about duration, your length of investment, when you think about how much risk you can take and what you can do with your money. So this is a more stark example of the best and worst 20-year periods. We wanted to show you if you really, really are the most sway person in the world, right, and you put your money at absolutely the wrong time, what would happen, right? And when we looked back in history, we figured out that that absolute worst time on the right side would have been January 1999. You put your money in right at the height of the dot-com bubble, right, and you had to sell, at the depth of the flash crash in 2018, right? And again, you actually, unfortunately, would have spent most, about half the time below what a CPF OA investment portfolio would have done for you. But you really pull it out and you look, even on the worst 20-year scenario. So what we're doing is every month since 90, right? We're looking 20 years. Every year we look for 20. So there are basically multiple 20-year periods. We keep moving and going. What's the worst 20-year period in returns? The worst 20-year period would have given you a 94% return on your money versus 65% for your 2.5% per year from the government. Right? The best 20-year period would have given you 2.7 times your money. Right? Sorry, would have given you a profit of 278% of your money, which far outstrips if you see, what your CPF OA would have done. Obviously, most of us are not that sway or that lucky, and we're somewhere in the middle. So this is to show you that if you have a long duration hold, long duration of investment, if you're starting earlier or even later, because remember, again, for most people, even at the point of retirement, they have 20, 30 years to go, right? As long as you can stay committed to the markets, most outcomes are actually relatively positive. And just to reinforce this point, if we take data from 1990 to September 2019, and we look at it on a monthly rolling basis, what this table shows you is basically what's your chance of beating that 2.5% hurdle? Because really, that's a relevant hurdle. 2.5% is risk-free, zero risk, right? What is your chance of beating that? And if you go up to 10 years, you'll see that the chance of beating that goes higher and higher the longer your hold period, right? And 15, 20 years, that chance historically, if you look back at either a pure stock portfolio, S&P 500 or MSCI World or All Country World, or even a bond index, the chance of outperforming that 2.5% goes virtually 100%, which is, I think, to me, sort of very convincing evidence. So this is how our CPF OA portfolios were done over time. On the right, this is just an index of 100% stocks, 0% bonds, and all the way down to 60-40 versus what a 2.5% per annum would look like. And this is a bit more sort of detailed information about our portfolios. And again, duration is very important. And I want to pull your attention to sort of the bottom of this page where the worst historical period, right? That's 12 months. If you had to put in all your money, if you had to pull all your money out 12 months from today, right? To buy a house, to go to university, to pay some bills, medical bills or something like that, right? Frankly, you're probably not very well positioned to invest in stocks or bonds. Because if you are really, really, really unlucky, you hit one of these worst historical periods, you could lose in the 100% stock portfolio up to 42% of your money, which is really, really scary because you had $1, right, that you were going to spend at the end of the year, and all of a sudden you're left with 58 cents. That's crazy. So, and if you look, basically, as it stretches out, as time goes on, once you go to 10 years, right, that return turns positive, right? So the idea is that if you have a decent hold duration, if you don't need your money immediately, you can afford to take a bit of market risk. This is a bit more about the portfolios that we're using in this example. We're very lucky to be the only ones to be able to offer the Vanguard Global Stock Index Fund as well as the Vanguard US S&P 500 Index Fund, which is on the CPF platform exclusive to Endowus. Included in our portfolios showed us a Global Emerging Market Opportunities Fund, First State Dividend Fund, Legg Mason, East Spring, and the UOB bond fund. So again, we don't believe in reinventing the wheel. First of all, we're not going to use our clients as guinea pigs. The returns will probably not be as good. The cost will be substantially higher, and frankly, the outcomes will be a lot worse. We believe in working with the best people out there, working with the best products and fund managers out there, so that we can do the best for our clients, do right by our clients. So why would you invest your CPF money? Because it's long duration money, because the probability of success in financial markets is high the longer your time frame goes. And I have a few more examples on that. And this sort of feeds into the next part of the talk, which is what is the right way to invest towards your goals? And when we think about this question, we think about whether there is an investment strategy that you as an investor and you as a person, as our client, can commit to holistically across all your pools of wealth and have a strong certainty of outcome. It's all about knowing that you'll have enough money in retirement and having that peace of mind, and also knowing that when times are really tough, like in March or April this year, when the markets were honestly falling apart and people would just sit there and stare at the screen, that you have the belief and the fortitude and the knowledge to just sit through it and continue sticking to your plan. It's incredibly difficult to, if you log into your portfolio one day and you see it down literally 30 or 40%, to continue to put in your monthly recurring investment, which I do. I have an automatic recurring investment. I put in a substantial part of my salary every month. It's really hard to stick to that and not be tempted to sell in times like that. But it's really about, number one, finding something that works for you in a holistic manner across all your pools of wealth, being very sure and being confident in the way it works, and having the discipline to stick by a program. And that will really, really give you the best outcomes possible. We tell our clients, we like to tell our clients, as an investor, really focus on what you can control. There's a lot you can't control. You can't control stock prices. You can't control the economy. You can't control the pandemic. You can't control where the stock prices go and what the stock market returns. I mean, if I had told you on January 1st this year that there'd be a pandemic that has locked down half the world, where tens of thousands of people are dying every day, and there would be a period of 2 or 3 months in Singapore where you literally couldn't leave your house unless you were going to exercise or going out to buy groceries, and I asked you, where do you think the stock market would be? You'd probably look at me and go, there probably wouldn't be a stock market, right? But look at where the stock market is today, and look at what the US has done. Basically, we're flat out on the year. So we have absolutely no control and no ability to predict near-term stock price movement of individual stocks. What you do have control over is what you do with your wealth bucket, your wealth chicken, right? How your career goes. If you put 100% of your focus on your career, you'll do well, you earn more money, and you can save more and invest more. You can control your asset allocation, which is the biggest determinant of return, and your behavior when times are good as well as bad. A lot of people, when times are very, very good, they get greedy. A lot of people, when times are very, very bad, they get too fearful, right? It's kind of going, the market does this, and you kind of go like that. And that's why outcomes are very, very poor. So this is a set of data, I believe from JP Morgan, that really highlights why individual investors have it really, really, really tough, right? If you look at 30-year annualized returns from 87 to 2016, US stocks would have given you 10% per year. For some people, 10% doesn't sound very, very high. I will tell you that's an incredible return if you can consistently do 10% per year for such a long period of time. What's really scary, however, is you look all the way to the right and you look at what the average investor does. The average investor does 2.6%. There are multiple reasons for that. Number one, Singapore is famous for holding on to too much cash in 0% yielding bank accounts. I think we have 30 or 40% of our wealth in the bank, right? And that earns you absolutely nothing. So no matter how well you've done on the rest of it, that drags your return down to zero on that portion. Number two, Singaporeans have a lot of their money, obviously, in property. That's a talk for another time. The properties have done well long term, but we believe that financial markets do a lot better. If you had simply just bought a passive fund that tracks the US stock market, you have done 10% per year, which is the best outcome of all of this. And the biggest reason, again, is because we're emotional beings. We keep too much in cash. We're always scared of, of investing when times are bad. When times are really good, we throw all our money and make absolutely worst behavioral decisions we can. We've been really lucky to be featured in more publications, Business Times, The Edge, Straits Times, interviewed on radio, etc. But this is a piece we write a lot. We have a newsletter that goes out called Insights. I strongly encourage you to subscribe, even if you're not interested in signing up for us today, for our services today. Subscribe to Insights and understand a bit more about investing and our approach to it. We wrote an article about time in the markets, not market timing, and we used the example of really the worst investor in the world. And this is a gentleman who really has the worst market timing in the world, and every time after he invests, he's a stereotypical investor. He gets really scared, things go wrong, he runs away. So this person has actually over his lifetime made a lot of money. He earns a high income, and in 1973, when he's just starting, he invests $100,000. The next day, market drops 37%. Wow, this guy gets so scared, he runs away. Doesn't look at a stock or a financial newspaper for the next 14 years. Finally, after 14 years, he's finally got enough courage to put another $100,000 in the market. And what would you know? He puts it in August 1987, before Black Monday. Markets dropped 20% up right after he's done. Right? Really cannot take it, go away for another decade. 12 years later, he comes back, right? Finally says, okay, you know, it's all about eyeballs. It's all about .coms. It's all tech companies. Markets are going up, and no way down, right? Puts $100,000 in December 1999, right before the market drops by 33%, and on and on and on. September 2007, before the GFC, markets go down 53%, and then again right before COVID. So even this person, who we call literally the worst market timer in the world, the worst investor in the world, at the end of the day, would return 6% per annum. And at the bottom of the value, at the bottom of the market, would have returned 6.3%, 0.33% per annum, because of the compounding effect of letting your money run in the markets. If you remember this previous slide, the average investor does 2.6%. But the person who decides to put their money, even the worst market timer in the world, who decides to put all his money in the market at absolutely the wrong time, can still do over 6% a year. And that's the power of investing in leaving your investments alone and not trying to be too smart to trade in and out of the markets. I mentioned cash just now. Cash drag is a very real issue for a lot of Singaporeans. And the reason is this. So, 10% I said is a fantastic return, right? Using an example that you want to try to double your wealth every 10 years, right? If you had 100% of your money invested in the market, so this is how much cash you have versus how much investments you have, and what your annual return is, in order to double your money every 10 years, right? And so obviously you have 80% of your money in cash with 20% in investments. So what this shows you is that you want to double your money every 10 years, right? If you're 100% invested in the market, all you need is 7.2% return per year, right? There's something called the rule of 72, and if you're interested, you should Google that. Great way to sort of approximate returns. But as you have more and more cash, your returns get really, really high. So if you're someone who thinks you can double your money every 10 years, but you have 80% of your money in cash and 20% invested, you need to earn 26% per year before you can double your money after 10 years. And maybe you have friends who think they can do 30, 40, 50% a year. I'll tell you, they're crazy. And the reason for that is, I'm going to jump forward to something, because literally the best investor in the world, this is Warren Buffett's returns. He's done 20% per year for the last 54 years, right? And he is one of the all-time greats. And what is amazing is that if you can compound, well, obviously no one is like him, but if you compound at 20% per year, since he started over 54 years, you'd be up 2.7 million %, right? You'd have earned 27,000 times your money, which is just absolutely incredible. Obviously, if you take it down to 7, 8, 10%, that overall gain comes down a lot, but still, that compounding effect is absolutely incredible. And again, so all of a sudden, this 26% return looks absolutely ludicrous, because if Warren Buffett can't do it, trust me, you can't do it either for every year in and out for 10 years. So there are a few other things that we like to talk about when it comes to investment strategy. One is making sure that you have global diversification. There's absolutely no rhyme or reason to performance in terms of different markets. And here we've shown S&P 500, MSCI Japan Index, MSCI EA excluding Japan, basically developed markets excluding Japan and the US, right, and emerging markets index. And you see that there are certain times when the US will do really well. Japan did really well through the 70s and the 80s, but became the worst performer for the next 2 decades, right? The US had a really rough 70s and 80s, but they came back really, really strong on the tail end of that. And there's absolutely no rhyme or reason to the way this works. And this is the next chart, which is by country annualized return of equities of the stock market, of developed markets. And if, by the way, if you can figure out a pattern here and you can predict this, please, you should absolutely go out and invest all your money in very concentrated stocks and bonds. But frankly, I can't see any pattern here. And it's very, very hard to figure out, even for the professionals, right, where financial markets will go. So we talked about Warren Buffett's returns, and going back to the idea of it's about the time in the markets versus timing the markets, right? Quoting Warren Buffett, we continue to make more money when snoring than when active. When you're too active, you actually shoot yourself in the foot and make stupid decisions. One of the largest US brokers did a study a while back, and they found that the clients with the best average returns were actually those that had lost their password and couldn't log into their account, probably because everyone else was trading a bit too much. So we really believe in an evidence-based investment strategy where long-term investors can really sit through years and years of good returns and waiting, right? And the best thing about a simple strategy like this is that you really don't have to think that much about it, right? You don't have to stress out. You don't have to spend 2 or 3 hours every day following the markets, following stocks, reading about what Trump is tweeting next, worrying about what impact that has on the China stock market. It's all about a very broad basket of investments, broad exposure to the world, betting on the fact that the world will continue to grow positively, right? And that you as an investor in the world will be a beneficiary of that. So coming back to Warren Buffett, our favorite oracle, right? He has done incredibly well, but there's some people out there, friends will tell you they found a great fund manager who can pick stocks and beat the markets, right? Morningstar is probably the leader globally in terms of evaluating unit trusts of mutual funds. Most amazingly, they rate funds on a 5-star basis, and 5-star funds that they rate are usually very, very well received, very well rated, very well received, and usually get a lot of AUM. What they found, unfortunately, is that there's absolute lack of correlation between past returns, rating methodology, and future outcomes. So the people that rate the funds can't figure out what are good funds versus bad funds, right? The fund managers that have done well in the past are not guaranteed to perform long term. And that's why a very active strategy trying to pick stocks, if even the professionals can't do it, we stand absolutely no chance. So if you look at the chart in the middle, which is pretty interesting, these are the ratings of the funds at the start. And at some point, the really well-rated ones go to the middle, the really poorly rated ones meet in the middle, and everyone's average. So basically, the ratings mean absolutely nothing. And people who've done well in the past probably don't have a very good chance of doing well in the future as well. What they did find, however, again by Morningstar, is that cost matters. And across every category of fund and US stocks, specific sector stocks, international stocks, bond funds, municipal bonds are sort of more of a US thing, but they found that across every category of investment in the US, or actually globally, that the most consistent predictor of return was the cost of the fund, and by that we mean fees. So the cheaper your fees, the higher return. Every single chart has the same relationship, which is amazing, right? Because again, if you want to be someone that doesn't want to spend too much time worrying about your investments, this is evidence. This is hard evidence that cost really matters, and the easiest thing you can do to improve your returns is cut costs out of your portfolio. And let's use a very simple example of why that matters. Someone may tell you that, look, it doesn't matter if I charge an extra 2 or 3% a year. It's all about how much I can make, right? And that's not correct, because the fees really compound over time and really eat away your returns. Let's say someone starts off with $1 million in day one, right? A lot of money, really lucky, has saved up a lot of retirement. If you assume that this person can earn 8.5% per year, but they have 2 options, one in a low fee fund, one in a high fee fund, of just 1% a year, it's really not very much, right? I mean, you're making 8%, 8.5% anyway. So all you're paying is an extra 1%. No problem now. It really doesn't work out big numbers. A big difference in the long run. That's wrong actually, because over time you'll see that the impact of compounding and that 1% really drags away your return. And that $1 or $1 million in year one, at the end of 30 years becomes 10 million when you pay less fees. And just when you pay 1% more a year, ends up 7.6 million. You've lost 2.5 times of your original investment, which is absolutely incredible, right? So this is why fees really, really, really matter. No matter what you do, no matter how you invest, please think about your fees. I see a comment that I'm being a bit soft on, so I'm going to speak up a little bit. The markets, and you just really have to believe in the markets, that they will work for you in the long run if you believe in the power of the markets. And this is, we reference the US a lot because that's where you get the most data. If you look at how a dollar would have grown from 1926 until today, right, you'll see that if you really believe in the long-term power of the markets, you do well. Bonds, government bonds, large cap stocks, small cap stocks. The annualized returns don't have to be very impressive. Again, remember, 10% per year isn't that much. But if you stretch out the duration really, really, really long, right, you're talking about 9,000 times your money after, granted, close to 100 years on just a 10% per year. So if you can get to 10% per year, or even 5 or 6%, you should take that, right? Don't try to be a hero and beat Warren Buffett, because you're not going to. Some people may say that, look, that's old history, that's ancient history, right? And that's not reflective of what's happening in the world today. You can look much closer today, 1999 until today, 20 years, or May 2019, and you'll see that you had a very similar type of impact in return over time, right? From global stock indexes, right? So the idea again is believe in the power of markets, take a long-term approach to investing, and have a very diversified portfolio. Because really, if you put 1 or 2 stocks in your portfolio and think that's investing, there's a very good chance you can be very disappointed at the end of it. So, those are some thoughts that we have about how everyone should be investing towards their goals, and keep costs low, invest globally diversified. It's about timing the markets versus timing the markets. And if you do that, you set yourself up well for success, right? No cash drag, put it in the markets, put it well diversified, and match your portfolio to your risk appetite as well as your investment duration. We think that money is meant to enable your life. It's not something to control your life. What we mean by that, it's not something where you should be thinking constantly about how to invest. We want to try to help people come up with a solution where you really do your research once you get convinced, and you just stick to it for the next 20 or 30 years. Money is the money you have is supposed to help you improve your quality of life. It's not supposed to control your life and give you problems on how to invest. How should I invest? Oh my God, I'm losing money. Oh my God, the market's up, the market's down. How do I think about Trump again? It's all about enabling you to have a higher quality life. So in our world, we like to think that we like to help you think and identify your goals very clearly, right? Have a process for which you can identify and achieve your goals, and give you access to the best products, the best expert strategies, and investment methodologies for you to accomplish these goals. If you're sitting at home right now and you like what I've been talking about, please feel free to just scan this QR and just check this out at endowus.com and start investing today. One thing I would like to touch on, just to talk a bit more about Endowus, is fees. As you saw, the impact of fees really dragged. This is what happened. This is what was prevalent in Singapore before Endowus came to the market, which was you had investors at the bottom, which is you. Then you had a whole bunch of distributors, everyone from the guy at the bank counter who was trying to sell you a product, to the brokers, to financial advisors, to sort of online platforms. And then you have fund managers, and then these people obviously sell you the product, and they take the funds from the fund managers, right? And what used to happen is basically that you as a customer would pay fees to the fund manager, and the fund manager shockingly would actually give a whole bunch of that fee back to the person selling you the product, right? And what happens then is that The person selling you the fund or giving you advice in the traditional sense is more motivated by who can give him more trailer fees, more sales commissions, than really thinking about what's in your best interest. We are very proud of the fact we took that all away. We only earn money, or we only charge our clients. We take absolutely nothing from the fund managers, so that Sam and the investment committee, Sam our CIO, and the investment committee, when they evaluate funds, when they evaluate portfolios, they pick literally what is best for our clients, right? Without any interference or consideration of what the fund manager can give us or anything else. We charge our clients and only our clients. And therefore, that means that we are fully aligned with our client success. Every incremental dollar you make in the financial markets, is a bit more in fees for us. So the more money you have, the happier we are, and the better off we are as well. Pricing, this is for those of you who are curious. On CPF and SRS portfolios, we charge 0.4% per year. On cash, it's a scale depending on how much money you have with us. And the idea here was really CPF and SRS is really your essential bucket, and we fought really hard to make it as cost effective as we could for people to invest their CPF and their cash and their SRS. So, please check us out at endowus.com. I touched on this briefly at the start, but it's important to understand how we are very different from a lot of other advisors and investment platforms out there. We as Endowus, we never touch the money. So this is the money flow, right? Your money, the moment you sign up for an account with us and you open it, if you want to invest via Endowus, you actually send your money directly to UOB Kay Hian. It never comes to us. We sit above it and we never touch that money. Kay Hian passes it to the transfer agent and fund custodian of the fund managers, which puts it directly into the financial market. And all along the way, there are multiple regulators which ensure that this conduct is done properly and the money is actually there, right? Endowus, we never touch your money. The only time we get access to your money is when we're charging our fees, and UOB Kay Hian will deduct the fees from your account and send it off to us. So literally, we have no access to the money in your account. And if we were to disappear tomorrow, if Kay Hian were to disappear tomorrow, your money would still be there in the financial markets in your name. So there's no worry about that at all. Very, very, very safe. As I mentioned, we will be having a few more webinars over the next couple of weeks. Next week, I'll be hosting Dinesh Dayani, co-founder of Dollars and Cents, talking about home buyers. Most Singaporeans are very overly invested actually in Singapore companies. That might be a bit of a bit too much, revealing a bit too much about what I think about this topic. But thinking about, as a Singaporean, really how much exposure should you have to Singapore financial markets? And the week after that, Sheng-Shi will be talking about financial freedom with Path Lion, Path Lion, very popular blogger if you guys follow him. So I'm going to stop here. That whole chicken and egg concept, if you like it and you want to read more about it, please check out our website. We have a great newsletter called The Insights, weekly newsletter, where we write interesting things like this, where Sam, Greg, and our partners, we sit in a room and we come up with really silly and interesting ways and hopefully entertaining ways to write about finance and investing and retirement planning, etc., etc. And if you want, this is that article that that part of this presentation references about chicken and eggs and investing for retirement in Singapore. I'm going to stop here very quickly, and I'm going to go to the questions that we have. I noticed that Sam has skipped dinner and has helped me answer a lot of questions while we've been going. But if you have any questions, please feel free to pop them up on the chat below the video window, and I'll try my best to answer the questions you have. So there have been a couple specific questions from Damien and Jeff about specific portfolios for time horizons of, let's say, 2 to 5 years, 6 to 10 years, or maybe someone slightly older in their 70s. I would say that it's very hard to give you specific advice today via such a broad forum. And you'd be much better served by opening an account and going through our onboarding to identify a bit more about your personal situation and also your financial needs and also your risk tolerance to figure out what may be slightly more appropriate for you. So I think that's probably the best way to do it. And let's see. There's a question on annual admin fees for the portfolio. As we talked about, CPF SRS is 0.4% per year, just going back to the slide previously. And cash depends on how much money you have with us. That ranges from 0.25% a year to 0.6% a year. Chin is asking when dimensional funds will be available on CPF OA. We're working very, very hard on that. And you'll be the first to know when we know. Let's see. Query 1357J about a lot of cash, whether to split and invest in portions or recurring manner over a period of time. I think it's really about your comfort level. There is no right or wrong answer. If I tell you to put all your money into the financial markets and tomorrow the market falls 10%, you will pull all your money out and never invest again. And so it really depends on your personal risk tolerance. And if you're the type where you can invest and close your eyes, then maybe you can consider, doing it lump sum. If you're one of those people that, really can't deal with as much volatility and wants to do a more measured approach, you could always break it up and put it in portions. You can think about it either usually as sort of a fixed time every month I'll invest a certain amount. So for me in particular, when I started Endowus, I had a little bit of savings from my previous jobs. So I put in a lump sum into my Endowus portfolio, and over time, as I have a salary, every month a certain amount of it goes into it. One of the coolest things about Endowus is you can set up different goals. And so I have 2 young children, 2 boys. One is 6 months and one is 2 years old. So every month, in addition to sort of automatic recurring investment into my portfolio, I have a small amount of money that goes into 2 goals for them. And when they turn 18 or 21, go to university or decide to work or decide to buy a house or decide to go to university or maybe decide to start a business, right? I can support them with whatever I've set aside for them. So I think there's one question SM is asking, about UOB Endowus or closing down. What will happen? So we have an arrangement with UOB Kay Hian where if anything happens to Endowus, our customers will be afforded the same terms that they have previously in terms of fee and access, and the same portfolio that can continue to run. So please don't worry about that. We do have a great office in Tanjong Pagar on Neil Road across from Pinnacle. We generally love to have clients walk in, drop in and say hi. We have great coffee downstairs at Populous as well. Unfortunately, we are not able to take walk-ins right now, but when things open up and ease up, if you have any questions, you are always welcome to drop in and say hi. Again, I strongly encourage you to subscribe to our YouTube channel. We do a lot of these talks. Sam is a very regular speaker. And Insights as well. There's some great content that comes out of that. So we're almost exactly on the hour, 8:03 from when we started. I wanted to keep this short and snappy and make sure that everyone still gets time to have dinner. Really appreciate you spending Wednesday with us. And please feel free to reach out if you have any questions. And hopefully you come on board for the journey. And we've managed to teach you something or help a little bit in terms of how you think about financial planning and retirement planning, across your different pools of capital. So thank you again so much for the time tonight.